and I forgot to hit record, so the first 5 minutes of this I'll be reviewing in the video tonight, and then we'll do a segue into this. So that's the second time I did this. Okay. So post-trade review, we'll look at, as I said, 15 trades that have been closed out since 8/1. Charts, in-house positions, and then Q&A on request. So trend gauge, we're above the 21. Medium term, 50-day moving average, we have gotten above that on most of the indexes as well. Long term, small caps finally poking above the 200-day moving average. We want to see continued strength in this to get us off of neutral and onto the bullish side, and then we start digging down into the sectors to see where the actual leaders are. And I think I've mentioned some of the leaders and how the rotation has taken place within the factors. So there's the trend gauge. Let's check the secondary indicators. Start off with the VIX. Let's bring this in here, and you can see, we have been inverted for a while. We're back in the bullish configuration that we want now, where we're going from lower left to upper right, and we're above the cash, which is the green dotted line. So this is positive for bulls. Check the McClellan Summation Index. You can see this double bottom that it put in here, and coming off of the bottom here. Now, this is a positive divergence. When you see this dip down to or as low as that, but on the RSI it didn't go as low, this is bullish. That's a positive divergence between the RSI and what's actually going on the NASI itself. And then we busted above the oversold level, and now we're approaching overbought. We're at 57 and 70 is overbought. Put call ratio, this is very much on the low side this morning, and normally this coincides with a market not making any more progress higher than it was for the day. Right now we're up about 0.5%. So if we continue to go higher with a very low put call ratio like this, I would be surprised. Normally a put call like this I would expect to be around 8 or 9, closer to neutral, but this is very much on the low side. And then finally, the fear and greed index. We spent a lot of the last couple of weeks in the fear mode, now going into greed. I know AAII, the bull bear ratio, they're above 50% bulls right now. It's been that for a while. So we're approaching where greed is taken on in the market, and if we get over here into the extreme greed, we start to look for a short-term top. So those are the secondary indicators. Now, massive factor rotation that I talked about. Here's a very good good example of how to demonstrate this. This is an iShares Momentum ETF, and you can see here how the relative strength just absolutely fell off a cliff this week, coinciding with this very harsh pullback. Now it's a little bit of a bounce today on this. Let's look now at VLUE. That is the iShares Value Factor ETF. And as you would expect, you see just the opposite, with a massive move in relative strength this week that actually started about a week and a half ago. This is when I started noticing and taking note that the portfolio, the Grotection portfolio that I run, started underperforming the indexes, and this vacillates quite a bit. You can see you've got trend up, trend down. This is a very harsh slope. Normally it's not more than a couple of day thing when we see overperformance or underperformance relative to the indexes in our growth portfolios, but starting last week and Monday and Tuesday, we noticed the growth stocks just were not making any more progress. I also saw a chart that said PEs under 15 are up over 5% over the last week. Meanwhile, anything with a PE over 30 is down on average about 3%, and that's more indicative of the factor momentum that's going on. Let's take a look also also at, let's look at the small cap index here, IWM. We know this has lagged for a while. Now finally, relative strength kicking in a major way at the beginning of this week. So this includes 2,000 stocks equally split between value and growth, equally split for the most part. But now let's take a look at IWN. This is the value index, and how harsh this move up is compared to IWN, much higher. You can see this lagged for an extended period of time. This harsh spike, you don't see a spike like this anywhere near in the past year, so I would expect this to level off a little bit. There are always overreactions in the market, but as I mentioned, I think that some big wirehouse that advises funds told them starting late last week, but effectively on Monday, get the heck out of your momentum stocks and get them into value. And that's what we saw. Here's also small cap. Here's the growth. And the fact that this is moving up, we know that the money's flowing into small caps, but it's not flowing into growth small caps to the extent that it's flowing into the smaller, the value portion of the small caps. You can see the bigger distance between price there. Now let's take a look on, let's take a look at the SPY. Again, equally weighted for the most part between value and growth, but now let's look at SPY V, which is large stocks but value stocks, and look at how the relative strength line starts to turn up about 2 weeks ago, and it exacerbated over the Monday and Tuesday, flattening out a little bit today. And then look at SPY G. This is growth. Down the last 2 days compared to an up move on the S&P 500, started trickling down over the last 2 weeks and really kicked in Monday and Tuesday. So the rotation not only into sectors, we know, let's look at the two main sectors that have benefited from this are banks. You see the big spike up in relative strength here. Mostly smaller banks though, not necessarily the bigger banks. And then also let's look at energy. Big spike up in energy, but again, for the most part, it has been smaller cap energy names that we're rotating into. So very clearly into small value and out of big growth. If I had to summarize it, that's for the most part what we've seen is out of small value and into growth. Let's see what's next on the list here. So how about the watch list? Let me bring in, this is the watch list that I maintain constantly. I've got it up all day on a separate screen, and it's got a couple of inverse or leveraged ETFs that we may or may not be getting into. And then this is what's owned in the Grotection portfolio. We're down to 5. Visa, MasterCard got stopped out of pins today, and it's just not a growth stock environment. We also still own gold and GDX. These also, from a momentum perspective, got sold off over the last couple of days. You don't think about them as momentum stocks, but a lot of money had flown into gold and GDX over the last couple of months, and they took a little bit of a break today, but now finally getting a bounce back today. So we still own GLG, GDX, and Visa, MasterCard, and 5. A lot of things in here are things that recently I got stopped out of. I always keep an eye on what I got stopped out of. Want to know how it's reacting. Is there an opportunity to get back into it? And then also things that are on the top of my watch list. And Monday and Tuesday, this list was pretty much, for the most part, solid red. There were a couple of exceptions. We're going to go through some trades in the 15 cases that I mentioned when we get to the next segment here. And then I always look at the big FANG stocks, and then a list of ETFs that represent pretty much all the sectors. Oil had led recently. This is the first time it's been down in a while. I always keep an eye on these two, the SOX and IGV. IGV just got absolutely slammed over the last 2 days. Semiconductors has been where some money is flowing into. Biotech, transports, and retail. Very much beaten down. Also saw a lot of money flow into them over the last couple of days. The XRT has a bunch of companies in it, and it's a good representation for broad retail. Broad retail has lagged very badly. We'll take a look at the charts of some of these in a little bit. But XRT and IYT is where money flowed into over the last couple of days on the larger cap side. There's banks, and then these are the 11 spider components that I track. Real estate has been having a little bit of a tough go of it the last couple of weeks, and that's contrary to what you would expect. But again, go back to what I mentioned about those three, CCI, SBAC, and AMT. Those are actually considered REITs, even though sometimes companies do business and they're really not in a REIT, but they set their corporate structure up that way, which is just them saying that we're going to pay out a certain percentage of our profits in dividends, and they get favorable tax treatment on that. So XLRE doesn't necessarily represent mortgage or real estate. There are some other components to it. Utilities, money flowing into it today. And then I always watch junk bonds, emerging markets, foreign stocks, and silver. Silver's had a very good run. And is pulling back near the 21-day exponential moving average. Then over here, I watch some closed end ETFs that we own in our blue chip income portfolio. IIPR, which is a marijuana REIT, MJ, which is the marijuana ETF, and it's a sector that was supposed to have a lot of positivity, but it's really given it up over the last couple of months. Three main China bellwethers, BABA, Tencent, and KWEB, which is a broad ETF. These are factor ETFs that are related to the S&P 500, but they slice and dice it in different ways. Some are more dividend, some are weighted toward volatility, but it's a good way. Somebody doesn't have their phone on mute or their computer. If you wouldn't mind muting it, I'd appreciate it. It's just different ways to slice and dice the S&P 500, and it gives you some insight as to how some different ETFs are performing relative to the S&P 500. And then this is what we own or is on the watch list of the blue chip income portfolio. These stocks here, and we'll review the charts of those in a little bit. And down here are some things that are not on the watch list, but more on the universe list that I want to keep an eye on as they might approach buy points or make it into the watch list. And then I watch Beyond Meat just because of what a crazy IPO it was. And I keep an eye on Bitcoin, ETF, GBTC, just to see what that's doing. So that's the watch list. Now let's get into some trade review. Yep, trade review. Okay, so 15 cases. Now these are, again, what you'll see in the trading style that I employ here is if something is growth oriented and it's trending above the 21-day exponential moving average, I want to have a 2/3 to a full size position in that. And for me, that's a 6% to a 10% size. If I'm taking my first entry into it, it'll normally be a third size, which is 3 to 5%. Or if something breaks the 21E, I want to reduce my larger position into a partial position and see if it holds the 50-day moving average. So the things that to focus on as we go over this are the 21-day exponential moving average and the RS line, and more importantly, the slope of the RS of both lines. Let me start out with something that I really noticed as far as growth stocks. Normally when I get stopped out of things that we hold, there are plenty more that are sitting there and ready to take their place. But something that I noticed over and over again as part of this sell-off was that leading stocks would break the 21-day exponential moving average, which it then rolled over. I don't want to own a full position on anything that's trending below the descending 21-day exponential moving average. It's just the way that the portfolios run. It's just the way I do things. I don't sit in. I just don't sit in things, and especially growth stocks. And you saw how bad some of them have gotten hit. Now, what I saw here over and over and over again is every time any of these leaders, and Adobe is a big leader, tried to rally back up above the 21-day exponential moving average, it ran into the 21 and stopped. Could not go any higher. The 21-day kept rolling down. It ran into it, lower, lower, lower. And until I start seeing some of these stocks get back above the 21 and the 21 round up, they're off my list. Tim just tried to call me, but he knows I'm doing this. Just type in the chat that you can hear me okay. I just want to make sure that everything's, all the audio is going out okay and you can hear me fine if you don't mind. Okay, good. Okay, so that's a common theme that I've seen with these leaders rolling over. They get under the 21, sometimes they bounce off the 50, get back above, but very few of them have gotten back above a declining 21-day exponential moving average, and that's why basically so many things have been taken out of the portfolio based on price and unable to get back in because they could not get back above the 21-day exponential moving average. So this is really the poster child for what we've seen in growth stocks, and this one actually held up quite a bit better than some of the things that we're going to take a look at as far as what got beaten down in some of these trades. So first trade we're going to look at is AMD. AMD has people. I know some people that are aficionados in chips, and they swear that AMD, that Intel is and NVIDIA have fallen behind AMD as far as graphic chips and so forth go. So AMD, it's also a stock that you rarely want to buy on strength because you can see every time it pops up, it tends to have pullbacks, sometimes harsh pullbacks, and it's not in a healthy state right now. So AMD was first entered on 531, which was, you saw this big move up on volume on 528, lower volume pullback. This is my favorite time to enter something right here. And then a bounce off this stacked 21 and 50-day exponential moving average. I love this setup. And 531, got into it, broke above, in fact, broke out. Notice this black line here. This is the S&P 500, and you always need to know what it's doing. Why? Because 75% of stocks will track what the market's doing. So you can see the S&P 500 was in a correction here. Meanwhile, AMD was just kind of marking time. And then notice the relative strength increase on AMD right here. I think they had a product announcement or something like this here. But it ran very hard. But as typically happens with AMD, it started giving it a lot of it back. Notice that the give back was on lower volume than the move up, so I'm still okay with it now. This was a, let's see what size was taken in here. This was about a 4% position size taken in it here. So got below the 21-day, still have half size, so it's not really a big deal. I'm going to hold it and see if it can hold the 50-day moving average, and it did. Then it got back above it. Everything going okay, and then here you see this gap down on earnings. I held this into earnings, gap down on earnings, 731, broke below the 50-day moving average. I'll give it the next day if it wants to get back above the 50-day moving average, but you can see what it did the day after 8-1. So this was stopped out with a 6.4% gain on the failure to recover. Sometimes when you see a gap down on earnings, that'll put in the bottom, but it didn't. It continued to go lower. And then, of course, it gapped higher here a couple days later. But when that happens, it happens. You can't focus on or worry about situations like that. It gapped up on a product announcement. but now you can see it's been struggling, and the relative strength trend has been down, even though the market, the S&P 500, has been recovering up here. So it's really just been trapped between this 30 and 31 area. Second trade, you know what? If they take as long as that one just did, we're never going to get done here. So I'm going to have to pick it up here. We're already 30 minutes in. So Lululemon, this was purchased on 6/21. So you see Lulu, you've got its earnings report. It tried to gap out, but what's the market doing? It's finishing a little bit of a correction, just starting to turn up. When the market's correcting like this, breakouts are a low probability of success. So here's Lululemon, 613, tried to break out, didn't, came back. Where did it bounce? Just where we wanted to, off the confluence of the 21 and the 50-day moving average. I watched it, it rebroke out, the market's acting a little bit, didn't take a position in it until here, 621. So right here, after it started to pulled back a little bit more, and what I took was a, this was first entered on 613, I apologize. So this was purchased here when it pulled back on the gap up day, and then I added to it on 621. So I had a full position, in this case I think it is about between 7 and 8%, and I'm just watching it, and it's trending above the 21, perfect, just what I want it to do. This hard break below coincided with a harsh correction in the market. This is why I love these charts, these MarketSmith charts so much. So when you see a big break in the stock, you look up to what the S&P 500 is doing, and 99 times out of 100, you're going to see exactly what's going on with that. So harsh break here, 82, 83, 84, 85. I got rid of on 8.2, the pyramided shares were closed out for a 1% loss. So that's right here. We broke the 21. I want to see you get right back above the 21, and I definitely want to see you hold the 50. And when it didn't, I got rid of the pyramided shares for a 1% loss. And then on 8.6, ran into I remember this intraday, it got below the 50-day moving average, came up, hit the 50-day moving average and couldn't get higher, and I just closed out the other part for a 3.5% gain. And then it reported earnings earlier this week. You can see it just kind of bouncing around along with the market. Gapped up on earnings. In a healthy market, a growth stock will hold the bottom of its gap. This didn't. This is a growth stock, so you can see it got hit Monday and Tuesday along with the market, now trying to rebound today off of the pivot. Next one is going to be GH. And if you have questions, type them into the chat window, and I'll periodically scroll through and try to. Richard, you want to ask about Google? When I get to the Q&A, pop that back in there, and we'll take a look at it. Next up, GH, Guardant Health. I've got a love-hate relationship with this stock. Got some nice gains out of it, but also some disappointing entry points. So GH was initially bought on 524. I've been watching this for a while because I was really impressed with this move. Did some research on the company, really liked what it was about. Bounced off the 50-day here, started to form the right side of the base. I had been watching it, and then they did a secondary. In fact, I bought and sold it right in here flat because once they announced the secondary, I just wanted to get out of the way. So when you see a secondary in a stock, the first thing that I watch is when does it get back above the secondary price? That's a real big sign of demand, and it's very bullish. So they came out with the secondary and immediately got back above the secondary price. So I entered this on 524 right after the secondary, right here around 76.40 was the entry point, and it just continue to act very well, just what I want to see, trending above the 21-day exponential moving average. Now here on 626, it broke below. I've got a full position in this because I pyramided on 812. Okay, that's all the way up to here, so we'll talk about it then. So I still got a half position in that. Broke below the 21. I'm still holding it, keeping an eye on it. I knew they had earnings coming up, and I was good with the story. Had a reasonable gain, and then it gapped up very nicely on earnings on 8.7. I took half of it off on this earnings gap up because look at what the market was doing at this point. Risk on was not being rewarded on the S&P 500. So when you're given a big gift of a gap up on earnings and the market is not cooperating, I like to take some off the table. So that's what I did. I took some off on 8.7 for a 43% gain. In fact, I closed the position out and then got back into it on 8.12. When I get back into something, as I said, I always keep it on my watch list. I want to know if it's going to come back to a reasonable reentry point, and you know I like the 21 EMA for an entry point, so I got back in on 8.12. Riding it higher now, breaks the 21-day exponential moving average, and GH I got out in two pieces on 8.23 when it broke below the 21, and the 8.12 ad was a 7% loss. I still owned a piece from 5.24, and that ended up being a 10% gain. So selling part of it up here for a 43% gain, watching it giving it up here, and then finally exiting on 8.23 all the way down to a 9% gain. So tough give back, but you can see what it's done since then. And again, you see the 21-day exponential moving average rolling over, couple of attempts to get back above it, hit it, fail, hit it, fail. I don't want to be involved in that. Once the 21 rolls over and you can't get back above it, it falls out of favor with me. Question, is the 21 EMA your only entry criteria? Absolutely not. But I love to pull back to the 21-day, buy leaders pulling back to the 21-day exponential moving average, especially when volume dries up and if it also coincides with the 50-day moving average at the time and the market's healthy. So a bounce off the 21, sometimes I add up through the 21. Next stock, Roku. Roku was a buy on 7.5, 5% position in Roku on 7.5. So where are we? We're back here. So this is a case of a move, made a nice move back up here on earnings, trended above the 21. I wasn't in it, I'm watching it. Broke below the 21. Very often leaders just spend a couple days below the 21. You can see this also coincided with a little bit of a pullback in the market. And then on 7.5, Roku got back above the 21 with some pretty good, well, it ended up being average volume, but I probably bought early in the day when it was good volume. So now I'm just watching it, acting very well. Then it starts to pull back, but look at this volume when it moved out here. Can't remember exactly what they announced here. There was some positive news or it was an upgrade. And now it starts pulling back. But look at the volume on the pullback, extremely light. So I'm still holding on. I took it into earnings. Took it into earnings, got the gap up, and I blew it all out on the gap up again. This was the market correcting, and you don't get them all right, and this is one that I clearly did not get right. From the 95.01 entry on 7.5, this booked a 26% gain here. You can see how nicely it acted through here, and I'm kicking myself the whole time. Very harsh sell-off the last couple of days. You can see the high volume and how hard it's pulled back. This got all the way up to 176. Low yesterday was 139. Yeah, that's a pretty harsh pullback. But okay, spent part of the day below the 21, got right back above the 21-day exponential moving average today. So I'm keeping an eye on it to see how it goes. This harsh pullback, there are a lot of stocks that are leaders that you see this two-candle volume signature happening from right here. The fact that it's happening from so far up here with Roku keeps it on the leaders list. We'll look at some that have really broken down later, but this one still stays on the leaders list. And yeah, kicking myself for selling out of it at a 26% gain when I could have got significantly more than that. Let's see, Sienna, I'm going to skip that. No big lesson to be learned from that. TTD is a situation. This is a broken leader, and this is one of the reasons why you obey your stops. So TTD, I entered and then pyramided on bought 3% and then added 3% on 8/12. So you can see TTD, a very strong leader. I traded this a couple of times up in here. Look to get back into it. I got back into it on 8/12. So here it reported earnings. You can see the move up and the move out. Not surprisingly, it reverses on earnings because the market's questionable. So at this point, this is still a leader. I'm looking to buy it at a low risk entry. For me, that low risk entry is around the 50-day moving average. So TTD, I bought it on 8/12 and 8/13. Here is 8/12. Pulls back to the 21-day exponential moving average, which is still rising. And then the next day, 8/13, it bounces off of it. So I added into it, and immediately it broke below it and started trending lower. So I took 8/20, I blew the whole thing out. So you can see I'm giving it a little bit of room. This is the 65-day exponential moving average here, this purple line. This very often catches things that overshoot to the downside on the 50-day moving average. Don't ever place your stop right below the 50-day moving average. The algos will seek you out and they will take their stock from you. You need to be a little bit below it. I like to use the 65 EMA or a couple percent below the S&P 500 if I'm going to hold it. So you can see it bounces back. 8/20 here was the day it bounced up to the 21. 21 started rolling over, and I exited here. And TTD was a 6.5% loss here on this bounce up into the 21-day exponential moving average. And you see it got back above it for a couple of days. But what happened? The 21-day rolling over was just too much for it. And then you see the big gap down here Monday as all the money came out of momentum stocks. Let's see what else we want to do next. How about Snapchat? So Snapchat was entered on 8/16 and then pyramided. Snapchat. So here we've got earnings, big gap up. Higher high on the second and third day is very bullish. This is something I keep an eye on, and I'm looking for a low risk entry point on a leader like this. So first entry was on 8/16, right here where it pulled back to the 50-day. Didn't buy off the 21 because look what the market's doing up here. The market's correcting. Would have been possibly a decent entry, but I'd rather buy off the 50 if the market's correcting. So 8/16, this is where I bought off of the 50-day moving average with a 3.5% position, holding it. Everything's doing fine. Comes back. It started to move out on 8/22, and it was big volume early in the day, and I doubled up my position, so now I've got a 7.5% position, and that pretty much marked the high. You see it get back below the 21, holding the 50, but now the 21's rolling over, and look how the 21 EMA acts as resistance to everything. I got out on 8/23. I sold the pyramided shares, which was right here the next day after the pyramid breakout failed. I got rid of that the next day. So that was a loss of 4.5%. And then on the 8/16 shares went out on 8/27, which was right here. It tried to make a move back up off a low, ran into the declining 21-day exponential moving average and failed, and I took a 4.8% loss on the initial buy there. And then you see, tried to move out, but again, momentum stocks, growth stocks hit on Monday and Tuesday, breaks harshly below, and hanging out around 15. This is still a leader, but the market is not rewarding growth stocks right now. Let's see what else. Let's go to team real quick. Again, the theme is on what you're seeing is here is the slope of where is the stock relative to the 21? What's the slope of the 21? And then I'm also watching what's happening with relative strength. And you can see all of these momentum stocks taking a dive. Started about 2 weeks ago, really kicked in Monday and Tuesday. So team 729 was the buy on this. So this is the earnings gap up. Well, not a gap up, but it started running hard on earnings on actually 729 is when I bought it. So then the Monday here, didn't buy the initial move up, the initial day. I bought it the next day when it pulled back to the 21-day exponential moving average. So 729, this was a 4% position, and it's acting fine. Half position, so I'm going to give it the fact that it's down to the 21 or the 50-day moving average here is fine. Just holding it, not really making much progress, and then I got stopped out on 830 for a 4.5% loss as it rolled over. Tried to get back above the 21 a couple times, then could not get back above it. Notice the slope of the line here while it's still trending up. Doesn't have as much problem getting back above it while the market is consolidating. But then on 830, ran into it, the slope of the line rolled over, couldn't get back above it 2 days in a row, though it tried, and I got out on 830, as I said, for a 4.5% loss. Next one is CrowdStrike. This went from a nice gain to a small loss. Got in on 719 on the earnings gap up day. Blowout earnings, Wall Street completely off guard, volume way above average, riding it very nicely, but it's a volatile stock, and I knew it was volatile. I always know what the ATR is of something that I'm entering. So this was a 4.5% position. Volatile, but never broke the low of the gap up day. That's something I'm always keeping an eye on. So at one point, this ran from 84 all the way up to 100. And this is a classic Livermore sell. Jesse Livermore, if you've read his book, you know that you got to watch how stocks act around the 100, 200, 300, 400 level. This was a classic Livermore sell in hindsight. But then growth stocks start getting hit. You can see the relative strength of this goes from good as it's trending up to crap as it starts rolling over. And here's another case of the 21-day rolled over exponential moving average providing resistance on the way back up. And this got sold on 823, which was right here when it broke below. The first day it broke below the 21-day exponential moving average. You can see what's happened since then. Avalara AVL, another stock that I've had a lot of success and then some mixed reaction to it. 624. This is a software stock. They specialize in tax compliance. The initial load-in was a 5% on 624. So good reaction to earnings here. Offered a secondary. Now I'm watching for the secondary price. Gets back above the secondary price on 624. It's above it, and it pulls back here to the 21-day exponential moving average. So this is where I took the first entry at 71.02. And it did exactly what I wanted to do. Very nice gains, riding up. 624. Let's see where my exits were on this. 87. I took some off the day before earnings as it broke below the 21. Now again, look at the market correcting. You can see from the black line below the 21-day exponential moving average, bounces off the 50-day, and I just wanted to reduce risk into earnings. So I sold on 8.7, about a 2% size of it. So I'm got about a 4% position here on 8.7, and then it gapped up on 8.8. I took some more off the table. So the first sell was a 13% gain, the second sell a 23.4% gain, and that closed it out on 8.8. I got back into, so again, but I'm always looking for another low risk entry on these, and I got back in on 8.12, which is here, on a bounce off the 50-day moving average. So I'm buying this. I got out at 80. Let's see, I got out at 87. I get back in at 82. When you can buy something $5 cheaper like that, that's pretty good. You bank the gain, and you've got this much to play with between where you're getting in and where you got out. So it's acting fine, holding the 21-day exponential moving average, and then finally on 9.4, see it starts getting below the 21, and it can't get back above it. Same situation, 21-day declining, acting as resistance. So out for a 2% loss on 9.4 and 9.6. which were the rebuys. So I got back in 4% on 812, 4% on 815, sold half of it, and then the other half, and all the way down to 72 now. My exit was 81 and change and 82 and change. Let's see. How about some things that we're still holding? That's going to do all the trades. That's not 15 of them, but most of the lessons are pretty consistent here with what I'm looking at. So let's move on to some charts of what's still owned in-house. And this is a situation where Visa and MasterCard are not software stocks, very obviously. They're retail stocks, but they're also momentum stocks. And the move out of Momentum Monday and Tuesday have hit these, even though there's nothing wrong with these. They're not overly expensive compared to, you can see their PE is 34. They're growing at 16.7%. They just print cash. It's transaction society. So there's just people taking money off the table. So we still own Visa, still own MasterCard in Grotection. 5 was the most recent add into Grotection that was bought on 8/29. I love the story in 5. These stores go profitable immediately. This sell-off is related to Chinese imports and tariffs on those imports, where they offered a cautionary stance, and then their earnings were exceptionally good here on 8/29. I bought this gap up on 8/29 for one thing, to get away from some of the more momentum type stocks, and also you can see the relative strength stopped going down on this. Looking at a chart that's going up is one thing. Looking at a chart that's going up as the relative strength increases is twice as good, because this could just be doing what the market's doing. But in this case, you can see the market consolidating and it's moving up into earnings combined with the relative strength. So this tells me to keep an eye on this. Then it gapped up on earnings. Small size, this was a 5% position. Almost got stopped out of it. But I looked at the 2 pullback days with volume well below average versus the move up day, the gap up day on earnings, and the relative strength line uptrend was still intact. So this one had a very nice couple of days over the last week. So money very clearly flowing into retail and discount variety. DG is another one in this sector that's acting very well, but there are also some landmines like Ollie got taken apart on earnings, but showing a profit in this one now and holding it strongly. And the last 2 that are being held in the Grotection portfolio are GLD. GLD was entered on 8/20. Didn't get this out of the box here. It was owned in our Robotection, which is just broad asset classes where we don't trade very much. This is a more active portfolio. This was bought on 8/20 on the pullback near the 21-day exponential moving average in this gap up day. And a little bit of progress, but now it pulled back, but it held 140. And it's still above the 50-day moving average, a 5% position in this. I'm giving it a little bit more room. ETFs, I give a little bit more room, but I am watching how this 21-day rolled over. And if it can't get back above it, I'm liable to pull the plug on it. Let's compare this to SLV, which I don't own, but you can see SLV, I've got 2 alerts set here for it. Above the high of the last 3 days, because that would be a breakout, and also a hold of the 21-day exponential moving average. And the relative strength on silver has been better during the lead up than it has been on gold. And GDX, the last position, still held in Grotection here. This was entered on, let's see, GDX on 626. So you see this gap up here on 620, and then it starts pulling back and consolidating. Entered on 626 right here along this 25 area. Pulled back, held the 21, pulled back again, held the 21, started moving up. This was a 5% position that was taken. Harsh break below the 21. Undercut, but get right back above the next day. So still holding it, another bounce off the 21. Now breaks the 21. And what was a much nicer gain is now down to, let's see, 7%, and we got 2% today on it. Yeah, GDX up 1.7% now. So we got up about 8-9% on it, but we've got the 21-day rolling over, broke the 50, trying to get back above the 50. I've got the 65 underneath of it. That's a worst case stop out, so I'll still be able to book a profit on it. But you can see the selling on gold, GDX, the last couple of days. And again, these turned into momentum stocks during their big run. Typically, you think of gold and gold stocks as a safe haven, but not in this case. They turned into momentum stocks, and momentum stocks that got sold off Monday and Tuesday really started late last week with the selling. So got to stop in here. That's going to lock in the profit. Question. Let's see. Don, can you please share any rules you follow for stock you hold before earnings? Do you trim, sell, hold depending on your gain? The gain absolutely means something. I have a spreadsheet that I use. I look at what it's a combination of position sizing and what the expected move is into earnings. So let's say I hold something and it's got a 10% gain, and I look at it and I've got an 8% position. If I look at what the expected move is, I double that. Normally, doubling it gives me a worst case drawdown of 20%. So if I've got, what I want to do is I don't want to give back any more than 1% of AUM on an earnings gap down. So what I will do is calculate the size that I would need to hold if, worst case scenario, it gapped down 2 times the expected move. And if that 2 times the expected move meant a 20% down move, what size does that equate to? That would only be a 1% hit on the portfolio. And in that case, with the math I just did, that would be a 5% size. So normally what I would have done is taken an 8% size down to 5% size and hold it into earnings. I am not one of the guys. I try to hold through earnings, but I do take into consideration what's happening with the market, where has the stock gone. If it just had a huge move into earnings, a lot of times a move up will get sold into earnings, but really what I'm looking to do is minimize my drawdown on a worst case scenario to 1% of asset under management, and that is that's the size that I hold into earnings. You talked about 821 crossover as trade point. Could you please explain? Sure. I don't have an 8 EMA on here. Let me get, really all it is your watch. Let's pretend that the 21 is the red line and the 8 is the green line. It's just a moving average cross, and then you watch on it, and then you got to take into consideration the volume. If you're too extended from it, I won't get into it. I would prefer a pullback of the 8 and a touch to the 21 as an entry point. But yeah, 821 cross is an entry point that I'm watching and I use. How do you use accumulation distribution rating over weeks? Seems like many growth stocks started to fade in rating over the last 3-4 weeks. That's very true. Accumulation distribution, I don't sell something just because of the AD. I pay more attention to what's going on the overall chart. Let's take a look at Starbucks is what he's talking about. It says most growth stocks started to fade in rating over the last 3 to 4 weeks. I'm watching more what's going on with the relative strength of the stock than I am what's going on with the accumulation distribution rating, but you're absolutely right. This dropped to an E. My thought is it probably dropped to an E because of these big 2 spikes lower on volume. But there was absolutely nothing wrong with this until the 21 rolled over on Monday and it got below it and couldn't get back above it. And now it's below the 50-day moving average, sitting on the 65 EMA. We are to the Q&A and charts on request. So put your chart requests into the chat window, and I'll take a look at them. Goog, I know somebody asked about that. Google had a great reaction to earnings. Normally, on a good reaction to earnings on a growth stock, you won't break below the low of the gap up day. But what happened after their last gap up? Market started to correct. So breaks below the low of the gap day, pulls down some pretty slightly above average selling here, but you can excuse it because of the big move up. A 279% move up on Google on earnings is a big move. It says that it's being bought by institutions, and you can see from a relative strength perspective, this has just really kind of been moving sideways, and Google actually gaining over the last couple of days. That's kind of rare for a growth stock, but again, this is a big behemoth. A lot of people park money in these as opposed to selling them. This is one of the better of the big stocks, and as long as it stays above the 200-day moving average when you hold Google, I give it the benefit of the doubt. Nothing wrong with this, forming a nice consolidation here while the market's consolidating. As long as growth stocks are going sideways with relative strength while the market's consolidating, you're in good shape. So nothing wrong with Google here. Netflix. If you follow me, you know I've had a very negative thoughts on Netflix since their earnings report. And this gap down, at first it started struggling when Disney announced their streaming effort. This gap down on earnings, now remember, two ways to play an earnings gap. The earnings gap down, it could do, does it put in a bottom, or does it cap the stock, or is it the stock gets capped quite just a bit above the high of the gap down day? In this case, it broke down the low the next day. That's a very bad situation for Netflix. Their earnings not well received and massive selling. This tells you all you need to know about it. It bounced up, ran into the 200-day. Look how the 200-day, this was really the big tell for me. Look how all touches of the 200-day going back here in this 340 area provided support. This is institutional support. This is money managers coming in to support the stock. Value guys love to buy at the 200-day moving average. But this is a classic case of support turning into resistance. 2 days right around the 21 and then around the 200-day, could not get back above it, declining 21, and the 21 has capped every advance on it ever since it had that gap down day. I would say, and you can see this is one of the stocks that I just want to know what it's doing, so I've always got alert set on it. In this case, I want to know if it gets back above 300 or if it breaks below the recent low of this consolidation. ENPH and PINs. PINs, I got stopped out of today. This was a brutal sell-off, and it's just a momentum high PE stock. I bought it on the gap up, had some nice gains in it, ended up selling it for, I believe, about a 9% loss on a 4% position. I'm always looking to minimize my losses to between 0.33 and 0.5% AUM. I've got a position sizing chart that I go by. I want to know what the ATR is of it. I divide the ATR by the stock price to give me an idea of how volatile it is. Then I set my stop and the position size that I take coincides with no more than a 0.33 to 0.5% loss on the position. And in this case, I got stopped out. Just got stopped out on pins. Got hit on it. Hindsight, this just hit very quickly. This was a nice consolidation on what looked like to be a very nice leader. I was very surprised in this. In hindsight, when it broke below the low of this consolidation, would have been a better point to get out, but I ended up getting out below the 50-day moving average. But still, the loss was within tolerance. I didn't lose more than 0.5%. ENPH. Yeah, I mean, this certainly should have been on everybody's watch list as a growth stock, but not anymore. This is just a case of momentum falling out of favor. You can see the relative strength dying, goes below the 21 very harshly. This needs to build a base now. Remember, this has had a big move. This went from 10 to 35. That's a huge move in a stock. And now it's just about filled the gap here. This needs a base. As far as an entry point, the 21 flattening out and the 50 flattening out, and they meet, and this comes back above it on some volume, would be a good low risk entry, and then the recent low would be your stop out point. That's one way to play it. But no, I wouldn't, but yes, and that was your question, base and the 8 turn up. That's absolutely what I would be looking for. TLT bonds outlook, and also do you use relationship to dividend stock and REITs? we judge, I mean, we look at a little bit of everything, Richard. TLT, we don't typically buy bonds in growth portfolios. This looks a lot like gold, actually, recently. This would have been a great entry right here, but again, we do own bonds, BND, in our robotection portfolio, which is just the broad asset classes. Here's BND, and this is what this is a robo portfolio with stops, and if this is above the 200-day moving average, we want to own it, and if it starts to break down, we start to take profits. TLT, it's coming into the 50-day moving average. This was a big move up from bonds from 130 to 149. It can give back half of it and still be healthy. And look, it's right about at that 50% fib level. It should hold the 50-day moving average. And if you want to own TLT, that would be a decent low risk entry. It should not break below, that 50-day moving average. And as far as dividend stocks go, there are a lot of dividend ETFs that they are not created equally. I've started creating a chart to break down. Some hold a bunch of energy, some hold no energy. It just depends on what factors go into it. But for example, look at SPYD. This is a S&P 500 high dividend index. This just got absolutely bludgeoned, and then it turned around, and now look at the relative strength of it over the last week and a half. These are bad for my blood pressure when you're in something that takes a big down move like this and then is going to bounce, because the way I do things, I would get stopped out here under the 200-day moving average. And then, I mean, you just got a harsh bounce here. Now let's compare this to another high dividend index. Look at NBL. This is the dividend aristocrat. No, it's not NBL, it's NOBL. This is another high dividend ETF. Nowhere near, look at the relative strength on this compared to the relative strength that we looked at on SPYD. Both high dividend ETFs. I don't want the one that's going like this, that's going down and then up. And this is going up because it holds a bunch of energy. I want this one that's making a slow and steady climb. And in fact, we own this in our blue chip income portfolio. COUP, Dan, yep. COUP was one of the last survivors of the SaaS stocks, and it's still holding up pretty well. Sitting here on the 65-day exponential moving average, it better not break below this 128.02 level. Good reaction to earnings on the gap up, although it tried to break out, but this is just not the environment for these stocks. Again, remember, this has gone from, you know, a stock that was around 70 all the way up to 150, so it did double. At some point, portfolio managers start taking profits, and they just can't go any higher. You also have to look at this. This is a fourth-stage base that it tried to break out of, and if you follow William O'Neill, you know that fourth-stage bases are likely to fail. So if you bought the gap up, they're just late stage. That's all it is. It's got a 595 PE, 33 times sales. They're just too expensive, and when the market goes defensive, these stocks just don't do well. This one is definitely held up well. Compared to AYX, which was the champion, never broke below the 21 while these things started correcting until Monday. This thing was down 15% on Monday. That's just brutal, giving back 2 months worth of gains in a day. The quick and the dead, right? Okay, it's 5 after 1. I think we're going to wrap it. Let's see. That's Q&A, charts on request, did the rotation positions, did the cases, looked at the watch list. IGV, I just want to wrap up with a couple of points here. IGV, notice this peaked here. It's subtle, but when it made a new high here, relative strength did not make a new high. Compare that to back here. This relative strength made a new high before the stocks in the index themselves made a new high, and the relative strength is trending up. So they're very healthy still here, correcting, still for the most part going sideways. This is the first sign of a fly in the ointment here. It makes a new high. Relative strength did not make a new high. Finally, it did make a new high here, didn't here, and then, man, they just got taken to the woodshed. This is just brutal. I think that this was the workday gap down maybe over here, but Right now, the 50-day moving average is being used as resistance for these SaaS stocks, or for these cloud stocks. And this one is also made up of some of the bigger software stocks and not necessarily just the cloud stocks. CLOU is a more pure cloud play, and you can see what's happened to that from a relative strength standpoint. Here you can see it really hasn't made a new low in price. Look where the relative strength is at this point. That's the jagged blue line. Look what the relative strength is doing, and then what relative strength does here. It just absolutely gives it up. Here, new high in price made versus where it is here, but look where the relative strength is. This is a sign that these things went from being outperformers to underperformers, and then they just got bludgeoned earlier this week. But it really started last week on a relative strength standpoint, or 2 weeks ago on a relative strength standpoint. This is the poster child for what's been done to momentum stocks over the last 3 weeks. That's going to wrap it. NetEase. Okay, we'll do one more. China stocks have been acting better lately, and this is certainly one of the better acting ones. I traded this for a loss back in here when it was acting well, and formed a little bit of a handle here. Good reaction to the earnings, so that's the first thing it's got going for it. And then a good follow-up reaction post-earnings. Pulled back. This big confluence of moving averages held it, which is a big positive. You can see the big blue volume bars coinciding with a nice move up in relative strength. And yeah, this looks fine. Definitely one of the leaders, and you can see that relative strength is making a new high along with price. NetEase is looking pretty good. So that's going to wrap it. And I will send a recording out to everybody that's on the list. The first 5 minutes that I didn't record, I'll go over in the video tonight, and then there'll be a link to both the review video tonight and then a link to this video. I'll send 2 links out to everybody. Thank you very much. Enjoy your day.